Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I'm really excited to have with us today Jeff Dorman, who is the Chief Investment Officer at Arca. We're going to talk about the crypto markets, the economic environment overall, as well as the most interesting opportunities coming up. Jeff, welcome to the podcast.
Thanks for having me.
Happy to. So let's start briefly just with your entry into your current business and your current role. What did you do prior to Arca? What's sort of the type of experience that you bring and what pulled you towards crypto?
Sure. Yeah. And for context, we started Arca in early 2018. So we've been through a fair amount of cycles and news flow in this space, as well as the evolution. I got started a long time ago, almost a little over 20 years ago now, as an investment banker. And then from there, I went into credit trading, traded everything from investment grade corporates down to high yield and distressed. And then after the financial crisis in 2008, that's when I moved to the buy side and started actually managing portfolios across debt and equity and other asset classes. Pretty much everything I did had a fundamental spin on it, always sort of deep value, ripping into balance sheets and income statements and, trying to find where, traditional fundamental value would come from. What made me leave and ultimately get into fintech back in 2013 was that very similar to last year in 2013, 2014, all the fundamental valuation stuff stopped mattering, and all we were doing was listening to the Fed speak every 6 weeks and trying to get a direction on where the market was going from that. And I found it pretty boring. So I left Wall Street, which I thought might be temporarily, but it ended up being mostly forever, to get into fintech because I wanted something that was new and different, because investing at that point just didn't seem interesting to me anymore. What I didn't know at the time was that when I got into fintech and started working with full stack developers every day, that all of them would start mining for something called Bitcoin and Litecoin and Ethereum. Just about every developer I worked with from 2013 to 2018 was involved in blockchain in some way, shape, or form. So my first understanding of Bitcoin and ETH and Litecoin came from a tech standpoint. But immediately I understood the Bitcoin macro use case as well, having spent 13, 14 years on Wall Street first, and could see kind of what was happening with the Fed and the government balance sheet and the endless debt cycle and everything else like that. So I started buying personally Bitcoin and then eventually Ethereum back in 2016. But I never really thought of it as a career or something I could do professionally until I moved to Los Angeles in 2017. And when I came out here, I saw that every person I met was involved in some way, shape, or form with digital assets, but not from a macro or a standpoint like I had come into it, but more from a tech standpoint. And I started learning about all the different types of blockchains and all the different use cases. And what I noticed from an asset management standpoint, selfishly, was nobody really knew what they were doing. Everybody was a tech entrepreneur or some sort of software developer who was trying to become an asset manager. And what I said is, well, how come there is no traditional asset managers trying to apply what they know about risk management and fiduciary responsibility and running client money to this new asset class? And that's ultimately what Arca set out to do. Was we said we can be a traditional asset manager with the same tried and true processes and compliance and risk management and IR and all the things we did in the debt and equity world forever, but apply it to this new technology and this new asset class. And I think we were one of the first to really start to put a fundamental valuation on digital assets, right? Not something like Bitcoin, but all the other ones that are more quasi-equity-like tokens that have real cash flows and real revenues and real amortization or inflation schedules and things that you could actually analyze using traditional fundamental analysis. So lo and behold, 6 years later, that's what we do at Arca. We've got, multiple different products across early stage, NFTs, traditional liquid digital tokens, and as well as some SEC registered regulated products, and really trying to just grow this industry through traditional best practices from Wall Street asset management.
That's a fantastic story. There are so many things I want to go deeper into, especially what it means to use fundamental analysis on tokens and cash flows of projects. But before getting there, I want to build first from the macro side, the relationship of, again, the Fed to the risk on, risk off environment, and then kind of dive deeper into the asset class and then go to the fundamentals. And you had said something up front, which is the reason you left Wall Street was because it got tiresome having everybody just listen to the Fed for guidance, whether it was going to be interest rates this way or that way. Can you talk a little bit about that journey, or it's almost 15 years now of the financial markets in large part being a function of available money and available credit? Like, what was that connection? Why were people so obsessed with the Fed and that guidance? Like, why was that the thing that was drowning out fundamental analysis?
The Fed decisions have always mattered, right? We're talking about rate cuts and rate hikes. Don't forget, the Fed only has, very limited playbook in terms of what they can run to affect monetary policy. So the Fed has always mattered in terms of what they did. It's just post the financial crisis, when there was so much of the debt basically transferred from the private sector to the government sector, and you started having just exponential growth of the government's balance sheets across the world. That's really where, that leverage increase had made it even more powerful in terms of what they were doing from a flow standpoint, right? The debt never went away. It's not like we have done anything across the globe in the last 2 decades to reduce the debt burden, right? If you look at debt to GDP across pretty much every country, it's been skyrocketing for 25 years now, and with a huge acceleration after 2008. What changed was that all of that debt that was accumulating at company levels, the LBO boom of 2007 and 2008, where every single company was over-levered, well, that's gone away, right? Companies now, and even personal individual balance sheets, are much healthier than they've ever been, because all of that debt was just assumed by the government. So when you have this massive debt load, especially at the public sector instead of the private sector, then these rate decisions have a huge, what we call operating leverage, right? It's just a massive sort of levered response to everything else. So, fundamental analysis still matters. It always will matter. It's just in some ways being drowned out by just these bigger flows of money in and out of the system because of this massive leverage across the globe. And specific to what I said about digital assets, that was one of the appeals to me of getting into here. Like, wow, here's this uncorrelated asset class. It really doesn't sort of move based on the flows of monetary policy. It doesn't move that much on what the Fed is doing. It was really just 2022 that was the anomaly. And the reason for that is that we had I think it was like an 8 or 10 sigma event relative to expectations, right? We went into 2022, we meaning consensus went into 2022 expecting 3 25 basis point rate hikes. And what we got was over 400 basis points of rate hikes. So that was such a shock to the system and such an outlier relative to what the expectations were at the beginning of the year, that just had a overpowering effect on every risk asset, from equities to fixed income to real estate to the jobs market, as well as obviously digital assets. But when you look at 2023, really, we're not responding that much to inflation and to rate hikes anymore, right? The delta, the change in terms of what could happen relative to expectations at this point is pretty minute, right? Whether we go from 5 to 5.25 or 5.25 to 5.5, that's a much smaller delta than when going from 0 to 400 basis points in less than a year. And we're really kind of back, especially in digital assets, we're back to it not mattering that much and back to having more idiosyncratic factors. And I really do think this is an uncorrelated asset class. And it was that in 2022 was the anomaly, not the other way around.
The other argument I've heard was that as digital assets have scaled up, for a long time, they were subscale, or they were a niche for techies, as you described, and they performed similar to early stage venture capital in, financial technology firms. Because they were subscale, they were uncorrelated. But then as the asset class got large enough to absorb institutional checks and hedge fund money and private equity money, the correlations all increased because the investors holding that particular capital are much more impacted by interest rates, right? So when an institutional investor is looking at a portfolio that is across digital assets, across equities, across fixed income, they might be doing things much more holistically in terms of their rebalancing of that portfolio. And as a result of that, creating kind of bigger shock waves that create these correlations. So does that resonate with you, or do you think we're not really there?
Yeah, 100%. And I say the same thing that you just said. I say all the time. And what people often don't understand is that usually it's not the assets themselves that are correlated. It's the people who are investing in those assets that drives the correlation. What I mean by that is, go back to, what was it, beginning of 2021, when famously the large family office, Archegos Capital, run by Bill Wang, had that massive leverage puke, and Credit Suisse was on the line for $5 billion, and all these other broker dealers and banks that were affected by it. You look at the 8 stocks that they owned, they were not correlated at all, right? That he owned Baidu and Viacom and Tencent and a couple others that by themselves had Discovery, had nothing to do with each other. But for a very short period of time, they were incredibly correlated. Why? Because the same guy owned them all and he was selling them all at once because he was margin called, right? So the assets themselves had nothing to do with each other. There was no reason why those specific 8 stocks would have otherwise been correlated. But for a very short period of time, they were because one person was selling. Well, the same thing happens in digital assets, right? Prior to 2022, for the most part, it was a very niche-owned asset class. It was owned by, like you said, techies and entrepreneurs. It was, maybe a couple of single-family offices and high-net-worth individuals here and there, but there were no pensions, no endowments, no, TradFi hedge funds and stuff like that. Well, towards the end of 2021, that changed, and you started to have a much bigger overlap with regard to who owned it, and more importantly, you had market makers like Alameda, for example, that were constantly hedging, right? One of the big things that we learned in the bankruptcy filings of FTX and Alameda was that they were basically just running a cross-asset correlation book, right? Every single time they were buying tokens from people on the FTX exchange, they were going out there and hedging it with the NASDAQ. So a big part of that correlation in 2022 came from a very small select group of market makers and macro hedge funds that were all trading these cross-asset correlation books. So when all of those guys blew up involuntarily, like Alameda, or just left the market altogether because of the carnage, those correlations went away. And I think, it's something to monitor because it could certainly come back. But for the most part, the actual idiosyncratic drivers of what makes a token go higher or lower is very different than what generally makes a stock go higher or lower, or a bond go higher or lower, or a real estate go higher or lower. Think about just Bitcoin, for example. Bitcoin really is a call option, right? It's a call option on the lack of faith in governments and banks, right? Or a call option on, anarchy when it comes to currencies. Well, if you look at what Black-Scholes' pricing model is for an option, well, of the 5 inputs, 3 of them are really important to Bitcoin, right? One is time. Well, there's no expiry on Bitcoin. It's basically a perpetual call option, which means that Bitcoin will always have a value just because of that perpetuity. The other is interest rates, right? Even though interest rates are much higher, they're still low historically. So low interest rates are good for options. And the other is volatility. And obviously there's plenty of volatility when it comes to digital assets. So, those 3 things, only interest rates really have any correlation to, the equity and macro world there. So I expect correlations to stay pretty low. We're back down to 3-4-year lows in terms of the correlation between digital assets and equities and bonds. And I think we probably stay that way until you get another round of just, euphoria where every single hedge fund and pension fund and endowment and bank is involved again. And then you'll start to see those correlations pick up.
I agree with you that the market structure is in large part the answer. And it's hard to imagine a market structure that's very independent or, that doesn't have a few large concentrated players for the current maturity of the space. But certainly I hope in the long run that does change. I want to just bottom out one more concept that you brought up, and that's around the debt cycle and Bitcoin's value and the call option against anarchy, the apocalypse hedge. Ray Dalio has a model of the debt cycle, but then also of kind of civilizational expansion and collapse that I find really interesting and compelling. And especially looking at the debt crisis in the last month, it brings that model to mind again, where if a civilization first starts to expand by deepening education, building out resources, expanding its economy, doing lots of organic growth, then through economic or military dominance, getting its currency to be valuable, and at the height of the civilization or at the height of its empire, that currency becomes the reserve currency for the world. And then there's sort of a coasting period where things start falling apart, like, education quality, productivity. And to make up for those underlying factors, you start getting debt throughout the system, whether it's on the consumer balance sheet or whether it's on the government balance sheet. And then you have lots and lots of debt expansion. And that's sort of the toy model. Don't know the extent to which it's right or wrong, but it's a compelling sort of caricature of the world. And it seems to be matching, the endless debt expansion and monetary expansion that's coming from the West. Do you find that motivating? Does that fit sort of how you think about the purpose of digital assets? Does that fit how you think about the current macroeconomic environment? Like, what's your reaction to that view of the world?
Yeah, I mean, first, from a factual standpoint, it's just facts that no currency has ever lasted more than 125 years or something like that, right? And most of them average around 80, 85, which is kind of right where we are with the US dollar now, right? If you think about, when we went off the gold standard, I think we're at year 60-ish now, or 65 or something like that since then. So, I mean, you're getting close to historical averages of when all currencies collapse. So that makes sense. And I think the easier way to think about what you just said is just that, governments and politicians don't like to purposely force recessions. So inevitably, when the growth stops, they just load up on debt, rather than doing what you would, be fiscally responsible to do if it was your own balance sheet, which would just be to stop spending and to go through some hard times. So I think from a, just a logical standpoint, that's why it happens. It's much easier to spend than it is to stop spending, especially when you have re-elections and other political games going on. So I certainly agree with all that. It's a little different, I suppose, in the sense that, because there's so much more of a global economy now versus, historically when these individual local nations would collapse. So, there might be some nuance to it. As it pertains to digital assets, to me, that only affects Bitcoin. I actually, even though I call this an asset class, the reality is I don't actually think blockchain or digital assets are an asset class. I think it is a wrapper that is now encompassing all asset classes, right? I actually think the ETF is the better analogy to blockchain than an asset class, meaning the ETF itself is just a wrapper, right? Even though the first ETFs were equity indices like the S&P 500, ultimately now everything gets put inside of an ETF, right? You have equity ETFs, you have bond ETFs, you have real estate ETFs, you have sector and niche specific ETFs like healthcare ETFs. That's kind of what blockchain has done as well, right? The first blockchain-based asset was a currency, Bitcoin. But when you look at others, they're not really currencies. Most of the DeFi ones are really kind of quasi-equity. You're also starting to see some debt-backed, digital assets. I mean, Arca itself created the first ever 1940 Act fund that has its shares traded as blockchain securities. And we put a fixed income fund in there. It's called Arcoin, ARCOIN. It's the Arca US Treasury Fund. It's just a short duration government bond fund that is traded, its shares, instead of through DTC, it's traded as, ETH-based tokens. So you have fixed income tokens, you have equity-like tokens, you have currency-like tokens, you have commodity-like tokens. As a result, I think what you're talking about with regard to, just this debt spiral across the globe and ultimately this need to protect yourself with an inflation-resistant hard asset like Bitcoin, yeah, I 100% agree with that, but that affects just Bitcoin. To me, the other assets that we're looking at here are more akin to traditional fundamental analysis, where you have to look at the revenues and the cash flows and the growth and the tokenomics and the inflation or the amortization or all the other ways in which you can accrue economic value, which really has nothing to do with inflation or debt.
Totally agree with you. That makes sense. I think the ETF is a good analogy. I think a hyperlink is also a useful analogy. So to the extent that a hyperlink to a book or to a song or to a phishing scam is not the substance of what it points to, but as a wrapper. Similarly, a token can incorporate in it any particular underlying. Before we switch into how you assess fundamentals and how you think about the factors that you mentioned, I just wanted to get kind of a temperature check from you on where macro is today, what it looks like, for the next year or so. What is your outlook on a recession? Are we going to have soft landing, hard landing? It seems like, at least according to some measures, the inflation numbers have met the rates and have peaked. Do you think that the economy is still going to wipe out, or what's going to happen?
Yeah, it's a good question. It's funny because, even though I have a background in this and I've, had traditional training in macro and microeconomics and finance. I mean, I got my degree in economics. The reality is, again, coming into digital assets, I didn't think I'd be using as much of it as I do. And I think, if you ask 99% of people who were involved in crypto prior to 2022, they probably didn't even know when the CPI report came out or when jobless claims, number. I remember back when people first started caring about it in the crypto world in like the fourth quarter of 2021, they were like, I heard there's jobs data on Thursday. I'm like, yeah, it's every Thursday for like the last 50 years. This is not new. It's just all of a sudden people care about this. But anyway, to answer your question, I think the comparison to 2008 is totally wrong. First, we'll start there. When you look back at what caused the financial crisis, again, first of all, the debt was on individual and companies' balance sheets, not government balance sheets, right? Government debt is very different in the sense that they can print their way out of it pretty much anytime they want. And what happened in 2008 was everybody who had mortgages, people were owning 2, 3, 4 homes. A lot of them had adjustable rate mortgages. There was just a lot of debt on individual balance sheets. So what happened is when you started to lose jobs and you started to have rising rates and all of a sudden you were underwater on your mortgages, that caused just a tailspin of housing failures and people moving for new jobs and all these issues that caused housing to collapse, caused further jobs to collapse, and ultimately caused a banking crisis. When you look at today, it's actually completely different, right? First of all, most people who own houses have already locked in really low rates. So even if your house in theory is down 30 or 40%, you don't actually have to sell. There's no trigger to make you sell because you've locked in 30-year mortgage with 1, 2, 3, 4% interest rates. Second, this working from home has eliminated what happened in 2008, which is people getting fired and having to move for a new job and being forced to sell their house at a loss. Well, nobody has to move anymore, right? Everybody works from home. So the 2008 analogy is completely just totally wrong, in my opinion. I think it's probably closer to 2001, which obviously you came off the NASDAQ, and then you had a couple of exogenous shocks, including 9/11. That may be a little closer, and then that was a pretty shallow recession. We ultimately recovered pretty fast. So I think that could happen. I think you could start to see a little bit of an earnings recession and maybe a little bit of a jobs recession, but it feels pretty shallow to me. The other part of inflation too is that revenues go higher during inflation, right? Everyone talks about the cost of everything going higher, but also from a company and earnings standpoint, your revenues go higher as a result of selling at higher prices. So I don't think you're going to have a corporate earnings-led recession. It certainly doesn't feel like we're going to have a jobs-led recession. So I don't know, if anything, pretty shallow. I don't see, a lot of the doom and gloom people out there. And, I think it's pretty well known at this point that most people who are really making any money from doom and gloom economics are doing it by selling newsletters, not actually managing money. Shout out to Nouriel Roubini, who's called 37 of the last 1 recessions. So, those who just constantly call for doom and gloom and, every time there's a hiccup, I mean, the equity market already fell 25% last year. Like, that was a pretty big reset. And there's real reasons for it to start to be climbing again. As always, I'll reserve the right to change my mind as new information comes in, but I don't see a whole hell of a lot right now that is leading me to believe that there's imminent doom and gloom.
I was really surprised by the unemployment rate being at a historic low. That's kind of not the story that is part of the the public narrative. The public narrative is all the tech companies are laying people off, personal consumption, consumer savings are at a historic low, consumer debt is at a historic high. But then when you look at the actual unemployment data, it's not bad at all. So I do think it's a tough one to call. Okay, let's switch into trying to figure out the fundamentals of the Web3 or the DeFi space. So moving out of kind of crypto as Bitcoin and into the projects inside of Web3. So all the DAOs, all the DeFi protocols, layer ones, layer twos, and so on. And I think it's been a pretty frustrating couple of years, at least for me, looking at these things in the sense that they're really interesting machines. Their software works under a lot of stress, whereas FTX and Celsius and other centralized custodial services, brokerages, and so on collapsed under market pressure and under the sort of malfeasance of human nature. The smart contracts-based platforms work just fine. But at the same time, the tokens of all these things, whether it's Compound or Maker or Aave or Uniswap, even of the best projects, let alone kind of the worst projects, have performed pretty negatively. How do you invest in the space? Like, what does it mean for you to look at the fundamentals of things? And then how do you react or how do you navigate an environment in which some of that stuff gets obliterated, no matter how impressive maybe the actual machines are?
Sure. So let me, go back to how I started this and my background, right? So I'm a fundamental value investor first. I read all of the Graham and Dodd book about how to value equities, the Fibonacci fixed income Bible on how to value fixed income securities, right? Eventually there'll be one written about digital assets as well. In fact, there's a lot of people at Arca working on that right now with all the educational content and valuation work that we do, trying to figure out what are the right techniques. So we care a lot about fundamental valuation. But just like in the equity and debt world, sometimes you have great company, terrible investment, right? You could have an amazing company that's just, has tons of revenues and profits, but is way over levered. And as a result, their debt and equity doesn't do well. Similarly, you can have a terrible company that's in bankruptcy, but they have a really good reorg equity that has levered upside on the recovery, right? So, you always have to separate how good the company is from how good the instrument is that you're investing in. And the same thing is true of the blockchain world, right? That if you really break it down, there's been 4 real success stories in the evolution of blockchain. The first is Bitcoin, right? Regardless of how you feel about Bitcoin's future or past, it's, to have a 12, 13-year run here, as it has, and to have made its way into mainstream society, that's a win, right? But Bitcoin itself is the first winner. Second is DeFi. At its peak, I think the total TVL of all DeFi protocols would have made it like a top 20 bank in the world by assets. Even now, after a pretty big drop in TVL, it's still top 50. That's a pretty big win, right? To come out of nowhere and a couple of years later have that many assets. You mentioned, really battle-tested protocols that have performed amazingly through periods of stress. The third is stablecoins. To go from basically zero AUM to almost 200 billion in a matter of a couple of years, and looking just around the world at how useful stablecoins are and how much it transactions. I think I don't have the exact stat in front of me, but I believe stablecoins processed more transactions than Visa and MasterCard last year. So huge win there. And then the fourth is NFTs. Again, independent of what you think about an individual JPEG, the idea of being able to put any asset on chain and have it be verifiable and ownable and unique is a pretty impressive technology and is going to go well beyond just, 10,000 collectible, items that are released all the time. You're going to have your healthcare records will be an NFT, your, coupons will be NFTs, you name it, and all these different areas where you're going to have, on-chain record or identity via NFT technology. So those 4 are, from a thematic standpoint, where we have focused at Arca to date. And there will be new ones. Maybe AI is a new one, right? There's a couple of different projects and tokens that are integrating AI in the blockchain world. So we'll continue to evolve and expand as well. But then when you go deeper, which is what you really asked about the valuation, well, then it just comes down to, if these projects are successful, does that value accrue to the token holder? And I think specifically with DeFi, that's really where the disconnect has been. And not because the DeFi protocols themselves haven't been great, as you mentioned. I mean, things like Aave and Compound and Maker and Uniswap and DYDX and GMX. I mean, again, these things have just been really, really, really remarkable technologies and resilient through a lot of stress tests. But the tokens were built wrong, right? They were built on inflationary schedules with a lot of early rewards being given to people where there was no stickiness to the product, right? So let's break down how a token in theory should have economic value. I always think of tokens as basically hybrid securities. They're part financial instrument like a stock or a bond, and they're part utility like a loyalty reward program. So, take Amazon, for example. If you want to participate in the upside of Amazon, you have to be a shareholder, and therefore you get a share in the profits and the growth of the business. If you want to be a power user of Amazon, you become a Prime member and you pay a fee and you get all these ancillary benefits that are not really financial or economic benefits, but they're utility benefits. You get your Whole Foods discounts, you get your movies, your music, your free shipping. You get to be part of this community of new information and products and things that come out. Well, those are very separate, right? If you had a Venn diagram, there's no reason why an Amazon shareholder has to be a Prime member, and there's no reason why a Prime member has to be an Amazon shareholder. And you can, apply this to pretty much any company, right? McDonald's. How many people own McDonald's shares are actually eating at McDonald's and vice versa? What blockchain really has done, and what digital assets has really done, is they combine those two. Effectively, you're getting the equity-like upside of the growth of a project by owning the token through the revenues and cash flows and other financial ways that you can accrue value. Maybe that's through buybacks, maybe that's through dividends, but you're also getting some sort of utility value, right? What sort of special features am I getting? It can be societal value, being part of the community. It can be, again, kind of loyalty member reward type value. So I think what the DeFi protocols have done wrong, and these were early iterations. It doesn't mean we won't have new, better tokens in the future. I mean, I mentioned GMX, for example. I mean, GMX from a token structure design is just designed much better than a lot of the early tokens that have come out. But if you look at a lot of the tokens, we'll just use Uniswap, for example. Uniswap as a entity creates a lot of revenue. There's a lot of trading that happens on Uniswap. The percentage of decentralized exchange volumes relative to centralized exchange volumes continues to go higher. We're at all-time highs now. There's, oftentimes Uniswap is, doing more volume than Coinbase. I think it was, just behind Binance in the last quarter in terms of overall volumes. There's a tremendous amount of revenues that come through Uniswap. But the Uniswap token was designed with pretty heavy inflation, right? In the sense that it was just airdropped to everyone all at once. And then there's a lot of Uniswap tokens that go to the AMMs, the market makers who are providing the liquidity there. There's no revenues or cash flows that are accruing back to the Uniswap token. There's been, proposals for a fee switch forever, and it just hasn't happened. And also the Uniswap token isn't used for anything, right? There's no loyalty, there's no membership, there's nothing there. You compare that to BNB, and I know Binance is all over the news, but the BNB token was designed perfectly. If you owned the BNB token, you got a percentage of the cash flows and the growth of Binance's business, right? Originally, they were taking 20% of their profits and actually using it to buy back the tokens. Now it's a little more loose, the formula they use, but still there's that financial component, whereas if Binance grows, you as a BNB holder will be rewarded financially in some way. But they also created a ton of utility for the BNB token. If you own the BNB token, you get discounts when you trade on the BNB platform. You can use it as collateral to trade futures and options. They even had partnerships throughout Asia with certain travel companies where you could get discounts. You are also part of the Binance community. Then you could use it as gas on Binance Smart Chain. So Binance just did a much better job in terms of how do I balance that financial value with this societal value, with this utility value. So to me, and think about when done right, well, that's why, in my opinion, Binance grew so fast, because every single Binance user was also a part owner. And they also, as a result, became power users and evangelists and sticky users and all the things you would want from a customer list. So I don't think the protocols in DeFi or other areas where the tokens have gone down, but the projects have gone up, I don't think the projects have done anything wrong. I think it's just bad token design. And you need some investment bankers or some token structurers to get in with these 23, 24, 25-year-old kids who have no investment banking experience and have no traditional corporate finance experience and teach them. Like, it's not enough to just create good tech. you also have to figure out those incentives and those alignments to make sure that your token accrues some form of value. Again, whether that's economic, societal, or utility value, it has to have some value as your project grows.
You mentioned GMX, so I'm curious as to your view on their token design and why you like that. And then the follow-up question around designing these value accrual mechanisms is regulation, right? Where everyone is doing their best not to pull in revenues in order to not be very obviously a security. So it's beyond just not understanding that revenues or dividends should flow to holders, but literally being unable to do so.
Well, before I get into GMX, I mean, that's just a crock. I mean, anybody who's using that as a crutch is completely doing that for their own self-interest, and it makes absolutely no sense. The definition of security has nothing to do with whether or not you turn on revenue, right? The second you issued your token, you were either a security or you weren't. What you do thereafter is almost irrelevant. So it is the Howey test that the SEC obviously points to all the time. 2 of the 4 of the Howey test are violated every single time a token is issued just from day one, right? There's a common enterprise and there's an expectation of profit. So you violated it right away when you issued the token. What you do thereafter in terms of turning revenue on or not is completely irrelevant. So I don't buy into that. And I would also, go back to what I've said multiple times as well on Twitter and in our blogs and everywhere else, is that there's nothing illegal about being a security. The issue about whether something's a security or not only affects the issuer of the token, right? Because it means that you're going to have to start paying registration fees and have, more standardized reporting. So before you issue a token, you want to make sure that you're not a security or not. Once it's already issued, it's too late. And 2 is the exchanges that are trading the token. So, there's nothing illegal about trading securities, right? There's tons of exchanges and brokers that trade securities like stocks and bonds. It's just that you have to, again, go through a fair amount of hoops and money to become registered in order to trade securities. So the issue is not, from an investor standpoint, I couldn't care less. I buy securities all the time. I couldn't care less what's a security and what's not. But if the SEC is hell-bent on calling everything a security, then they have to make it easier and cheaper for the token issuers and the token exchanges to be able to trade that. And I think that's the big problem right now is honestly, the entire industry would probably be better off if everything was a security at this point and get, rip the Band-Aid off and get past this. The problem is the SEC has made it impossible for anybody to comply with their rules. So anyway, I get the sensitivity, and it's a nice, buzzword for anybody who doesn't feel like, giving back to their token holders and saying, oh, we can't do it because we're worried about becoming a security. That's a crock. You either are or you aren't, and it has nothing to do with whether or not you give back to token holders at this point.
Right. It is just impractical. It is not possible to comply with what the SEC would want, right? So if you take the Uniswap token, right, and you say there are people from 50 different countries holding this thing, none of them have been KYC'd, none of them have provided any documents to any broker-dealer, and nothing's retained. There's no fix to that with today's infrastructure.
I'm not saying it's plausible or possible to even comply at this point once you've issued it, but I'm saying a team that is saying, oh, we can't do right by token holders by giving you more revenue or by doing a buyback because of securities law, that's the part that's wrong, right? If there are in the crosshairs already for being a security, it's independent of whether you issue a dividend or a buyback or some other way.
Right. Okay. I'm cognizant of the time, and I want to cover one other topic, and maybe we'll circle back to some of the previous ones. But the topic I want to talk about is activist investing, and in particular, DAO treasuries and getting involved in DAOs to unlock the value of their treasuries. What's been your inspiration on this topic? What's been the work that you've been doing, and how do you think about it?
And I think the word activist investing is always funny because I think in general it has a negative connotation just because you have this vision of corporate raiders and maybe going back to Pretty Woman and private equity ripping a company apart and all that kind of stuff. The reality is most activist investing is actually more constructivist than it is hostile. you generally are trying to be constructive and help companies and projects. But that being said, like to me, activist or constructivist investing is really just a subset of value investing, right? What is an activist? What is a constructivist? What are they trying to do? They're trying to unlock value that is being trapped for whatever reason. And typically in the equity world, what you're doing is you're basically saying that we don't think that management and the board of directors is being a proper steward of capital and of the business. And therefore, we're going to run a proxy fight and try to get a board seat and try to change management so that we can change direction of a company or unlock it, right? Again, you always hear about the hostile ones, but there's thousands of them that are not hostile at all and are just stewards of change. In the token world, I think we, in some cases, are we being Arca, I think in some cases are labeled as activist investors, and we're not. We're value investors. But occasionally, in order to unlock trapped value, you have to voice your opinion. And because of the way a lot of decentralized projects are run, that's what governance really is, right? That's what being a token holder of a DAO really is. Effectively, you are the board of directors. You don't have to win a proxy fight. You can just vote immediately. So some of the things that we've done historically, I think the first campaign we ever did was with Gnosis in 2019. And it started just simply with the fact that, Gnosis raised a ton of money and they basically gave out these GNO tokens and received ETH in return. And over, 4 years, ETH went up 10x and the GNO token went nowhere. And all of a sudden, these guys were sitting on a massive balance sheet while GNO token holders were getting nothing. And what we were saying was, look, you guys raised money under some pretense of products you were going to build. Most of these products never got built. And you're sitting on this war chest that you don't need. And you're basically just yield farming and doing all kinds of, things on your own that are not being driven by any discussion from token holders that are not providing value to the token. So it was a 9-month campaign that essentially we were trying to get them to buy back the tokens. Ultimately, they settled on explicitly backing the token by the treasury. So we got to the same point, which is that the token closed its gap relative to the treasury because of that explicit backing. More recently, we've been involved in one called Aragon, the Ant token. And it's a similar thing. The token was trading at a massive discount to the treasury value. In this case, it had less to do with what Aragon was doing wrong with regard to their project, but more about they have a $200 million treasury and their expenses are under $10 million a year. What startup company in the world needs a 20-year runway? That's just insane. And there had to have been better ways to utilize this money than just sitting on it while the Ant tokens were going nowhere. And really, more holistically, any time an instrument trades below its treasury value, whether that's a stock or a token or anything, that's the investor's way of telling that company or project that you are not being a proper steward of that money. You are not doing what you need to do to grow shareholder or token holder or debt holder value. That's a very explicit way of the market telling you that, right? Most companies, the stock trades at a huge multiple of your treasury, or the debt trades at a huge, premium to that treasury. So if you are trading at a significant discount to that book value, that's the market's way of telling you you're doing something wrong. Either you haven't come up with a proper growth story that makes us feel that you're going to use that money in a proper way, or you are doing inappropriate things with that money, or you really just haven't thought about it. Whatever the case, that's why I think token holders are such a beautiful thing compared to equity and debt, right? If you own an equity or debt instrument, most of the time you have no say, right? You are just some passive owner. But when you own a token, you have a voice, and you can immediately, as a part of that board of directors, you immediately can say, hey, I don't like what you're doing, and here are some changes, and here's my proposal, or here's my, what I'd like you to vote on to force change. And I think Arca has the resources and the amount of people and the, visibility to do it more loudly than others. But anybody can do this, right? You can be, a kid sitting in your parents' basement and write a proposal. And if it's good enough, people will vote on it. And I think it's really, token holders are the checks and balances of the system. Any company or project who raises money and is sitting on money, they have a fiduciary responsibility to do something with that money that aligns with token holders' interests. And sometimes that's financial value, sometimes it's societal value, sometimes it's utility value, the same three things we just brought up earlier. But they have a responsibility. And if they're not doing it correctly, then token holders, as that checks and balances system, have a right to voice up and suggest change.
It's quite inspiring to think of an economic and financial system where you have much broader stakeholder reach and, ability to participate in the direction of the protocols, as well as the direction of the treasuries of the protocols, the product. And I think tokens, there's pretty good evidence that tokens are able to create much more engagement and much more governance and a sense of ownership of projects than the corporate governance that we have in the traditional equity markets.
Yeah, 100%. I mean, look how many stakeholders in the traditional world are competing against each other, or at least have no economic alignment. Think about like JP Morgan shareholders versus JP Morgan bank customers versus JP Morgan employees versus the communities that JP Morgan puts up a branch or an office. There's no real alignment there. Whereas with a token, it's one instrument. That instrument is owned by the founders. It's owned by the developers. It's owned by the community members. It's owned by investors. As a result, you have this natural just alignment and incentive program to do what's right by all of them at the same time. And I think that's really powerful. And we haven't even scratched the surface of where we're headed with that. I mean, I think very soon, every corporation will have a token. Every municipality will have a token. Every university will have a token, because it really does economically align and societally align people better than what we've seen. I mean, for example, what if New York City issued a token one day, and that token was used instead of normal general obligation bonds or revenue bonds that you would normally issue to fund a project? What if they just issue a token, and that token, gives you discounts on the subway, or it gave you faster access at LaGuardia and JFK, or it gave you, the ability to get priority at Central Park if you wanted to throw a party or go to Shakespeare in the Park. I mean, there's all these different ways that you can combine and align people, both economically and socially and utility, through a token. And universities, same thing, right? You have a child, you buy Harvard coin. If in 18 years your kid goes to Harvard, you can use that for tuition. If not, you can trade it for Duke coin. All the boosters, all the donors, all the, future students, all align around this token. There's just so many different, Netflix. What if Netflix had a token, and that token gave you discounts on your membership, or you could pay forward for future, months if you think prices are going up? Disney could have a token. I mean, you just go down the list, and it just makes more sense than the traditional way that we've done it with debt and equity and having, customers completely unaligned with the financial interests of an entity. So a lot of that is being held up by, regulation. A lot of it is being held up again by the fact that there's just no investment bankers being paid to think about this stuff yet. But I think we're headed there for sure.
Anything that gets me out of JFK faster is a win in my book. Jeff, it's been fantastic having you on the podcast. If our audience wants to learn more about you or about Arca, where should they go?
Sure. Yeah, Nick, thanks again for having me. Enjoyed the discussion. Individually, you can find me on Twitter, pretty active there, at jdorman81. You can also read a lot of educational content coming out of Arca just on our website, which is ar.ca. We have a ton of blogs and fundamental valuation webinars and all kinds of different pieces of information that people can educate themselves, both about Arca, but more importantly about this industry.
Fantastic. Thank you so much for joining us today.
Great. Thanks, Lex.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things FinTech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.